This is the Self-Storage Podcast, where we share the knowledge and skills from the industry's leading investors, developers, and operators to help you launch and grow your self-storage business. I'm your host, Scott Meyers, and over the past 16 years, we have acquired, developed, converted, and syndicated over 2 million square feet of self-storage nationwide with the help of my incredible team at selfstorageinvesting.com, who has helped thousands of people achieve greatness in self-storage. Hello, everyone, and welcome back to the Self-Storage Podcast. I'm your host, Scott Meyers, and this week's guest is Scott Lewis. Scott is the co-founder and chief executive officer of Spartan Investment Group and is responsible for the strategic direction of the company and ensuring it aligns with their mission to improve lives through real estate. Scott also shares the stage with me at the Self-Storage Mastermind, where we corral and host an elite group of self-storage rock stars once a quarter for the most amazing business and personal growth experience you'll find anywhere in our industry. In addition to Spartan, Scott is also in the U.S. Army Reserves and a combat veteran. Scott graduated from Michigan State University with degrees in chemistry and marketing, and from Catholic University with a master's in management, and from Georgetown University with a certificate in project management. In his free time, Scott enjoys spending time with his wife, Lindsay, mountain biking, skiing, and chasing their Jack Russell Terriers around the yard. And on this podcast, we discussed how to properly scale your team and the importance of hiring based upon core values. So without further ado, please enjoy my conversation with Scott Lewis of Spartan Investment Group. Well, glad that we could catch up once again and wanted to really just kind of share open conversation and just, hit the cameras, turn the cameras on as we chat through really what's going on over there at Spartan. You guys have hit the Inc. 500 list again. As we've discussed, you are leasing another office again due to your growth. And so I thought it'd be best that we turn on Storage Nation to what it's like to be head of a company, a self-storage company that is just growing by leaps and bounds, and all that goes with that, the challenges, the beauty of it, and how you hit the gas, how you hit the brakes, hiring, all those things that go into that. But let's first, kind of a recap as to where you are right now. At the time of this recording, we're in third quarter of 2022, and we're heading into a recession. What does life look like right now over there at Spartan?
Life's pretty good. We have somewhere in the state of our acquisitions pipeline about 450 million of acquisitions that carry us through the end of this year and then into probably about half of next year. And obviously the debt markets are a pain in the butt, but they are for everybody. We've got a really good capital markets team. So we've been able to get lenders to the table with term sheets and actually closing some loans that we've had to close. Of course, there's been last minute retrades and some last minute shuttling money in that we didn't think that we needed. But all in all, things are okay. I'm actually really excited about the coming recession. And over the last couple of years, and I'll say 10, if you didn't make money in real estate, you should really think hard about joining like a circus or the theater, because it may be better for that, right? So what we haven't seen is when tough times come, it's those that have built the correct infrastructure to succeed in really good times, but then also succeed in really bad times, and maybe not succeed, but at least weather those times. So things are pretty good here. And I'm actually kind of excited about the upcoming recession, because one way or another, we'll know where we stand.
Mm-hmm. Well, the listeners are used to me saying this, and that is, we have been anticipating this recession, and we don't celebrate pandemics and we don't celebrate recessions by any stretch, because there's a lot of challenges that people go through and businesses go through as a result of a recession. But we know that historically self-storage does very well. And so we have been preparing for this since 2008, call it 2010, on the back end of that recession. And we all got really good at raising private equity so that we had cash available, or at least at the ready, so that we could take advantage of not people, but the opportunities that'll come as a result of this recession. Because as you mentioned, Scott, there are a lot of folks that didn't prepare for this. They had this big wind in their sail and at their back and assumed they could do no wrong. And there are a number of projects out there that, because of that, they weren't built on that solid foundation that you mentioned, that they're going to run into some troubled times. And during a refinance, they may not have built up enough value and or they may not have attracted enough capital to their development project, in which, those are the opportunities that we'll see if we can come along and help joint venture, acquire. If history repeats itself like it did the last time around, that we know that is what is coming, and it is what separates those folks that have been through a recession before, that kind of know what to expect, versus those that felt that they could do no wrong. So what does that specifically look like for Spartan? Does that mean that you have a war chest of capital? Does it mean you're increasing your marketing efforts? How are you approaching this recession? What are you doing internally that's a little different in how you approach the market?
Yeah, so the answer to that is yes. And one of the things that I often talk about is optionality. Mm-hmm. One question we get asked all the time from investors is, what's your exit plan? And an answer that surprises a lot of folks is we don't have one. And there's a reason for that. It's not because we haven't thought about it. It's because we want the optionality to be flexible. There's a great kind of metaphor to think about when coming into troubled times. And that's a tree blowing in the wind. If you're super stiff, you end up that tree falling on the ground with your roots hanging out. And nobody wants their roots hanging out. That's a bad place to be. But you also watch some of these big trees, 2 feet in circumference, just go back and forth in the wind. And they survive the storm. And it's because they've built in that flexibility inside of their root system, inside of their overall superstructure inside that tree to be able to survive that. Otherwise, it snaps in half. So hopefully inside of Spartan, we have built that flexibility. And that's flexibility in capital with having some larger partners, but a lot of retail investors, with having a manageable debt load. We've never really gone out there and been super aggressive on debt. I think on an LTV right now across our portfolio, we're at like 51% or something like that. So LTV pretty low. LTC, we're in the mid 60s. So even then, I mean, some folks, even folks that we know, we're trying to push into the high 70s, low 80s. That's okay with appreciation. And there is a winning strategy for that. But it's one of those things, the music stops and you're looking for a chair and it's not there. It could be pretty dicey. So in addition, we're building more systems. We're at scale now. So we've got 60 active facilities. So that our economies of scale are starting to change with some of our staffing. Some of our ability to negotiate better prices with vendors are getting better. Our ability to scale our capital stack with more institutional providers, both on the debt and equity side, is beginning to grow. So we're getting, I would say, risk mitigation in multiple domains across our organization, such that we can mitigate risk in like a multimodal kind of system across, in case one risk comes to bear that we can't mitigate here, we might be able to still insulate against that risk over here.
And Scott, I want to unpack a couple of those, but here's a point that I want to come back to, and this is a little more overarching and perhaps philosophical, but I've heard you mention optionality at Spartan and in your organization in the way you approach decision-making. If I've heard it once, I've heard it at least probably 50 times as you're presenting at our mastermind and talking with folks about, hey, what's your optionality? It sounds like you got 2 bad options there. You need to dig a little deeper, or whatever that looks like, and building a framework and what that looks like within Spartan. And I guess what I wanted to unpack a little bit is that for those that are listening out there, if you're running a business very well, you're running a tight ship, like what Scott has built at Spartan and his entire team, it means that you're buying right, you're underwriting correctly, you've got profits that are built in on the front end, you're not overstretched from an operations standpoint, so that, if you do need to pivot into business, or if a particular asset, a development project or a particular individual existing facility, you have to pivot and move and do something different. Well, you built in your profits on the front end, you built in that margin, so you have some optionality and the ability to be able to do so. And I think many investors feel like they need to have the answers, because what if their banker asks, what do you plan to do? You need to have the answer at the ready. If your private equity asks, well, what's your exit strategy? And if a recession hits or when this or that happens. And I think many people feel as if they need to have the answer, which is the right answer. And to me, the correct answer is the one that you just gave. If you're running a good business and you're buying right, you're underwriting correctly, then the confident and bold answer is, I don't know. But we will have an exit strategy that will be profitable because we have optionality that is built into our organization and is built into each and every one of our projects. And that is enough. And you say that confidently, that is enough to satisfy any lender and or private equity partner and even potential employees as they're looking to come into your organization. How would you respond to that?
That's exactly it, right? So Annie Duke, in her book, Thinking in Bets, great book, highly recommend it to listeners, talks about decision-making having 2 components, skill and luck. Skill is obviously a set of skills that you use or a set of systems and processes to make the decision. And luck mainly comes from your operating environment, many of which the variables you do not control. You do not control when somebody invades you. You do not control when a virus is unleashed. You do not control when a government entity puts in price controls. You do not control when the Fed messes with rates. What you can control is your decision making. So when you look at talking to investors and banks and everything, it's really your decision making process, whatever that is, that's on display. Because sometimes really skilled decision makers have bad luck. And sometimes really poor decision makers have really good luck. Given the two options, especially when you're looking back, we get the track record a lot. What's your track record? We got to be careful because a lot of people have great track records right now, but it's because of luck. It's not because of skill. They underwrote some nonsense and then the cap rate's compressed and they're winning by appreciation, but they guessed.
And 50% of that was a bull market.
That's right. So you got to look back and then see, hey, what skill? What is your decision-making process? For Spartan, we use the military decision-making process. It's an Army process that I've adapted for civilian use inside of Spartan. There's 7 steps clearly articulated. I could walk anybody through it off the top of my head, and a good majority of the Spartans could as well. So when you look at that decision-making process, that's more important than the actual decision. So when people are talking about optionality, it's a decision-making that supports optionality given a set of evaluation criteria in which guide that decision to the right course of action. What a lot of folks do is they fall in love with a decision. There's plenty of people that are like standing in their driveway, looking at that red Corvette that they just got when their wife was pregnant, being like, man, that's a good idea. Right? It's your decision. So of course it's a good idea. Nobody looks at me like I'm an idiot. That generally is not the self-talk that you have. And you're like, wonder where the car seat's going to go in that thing. Like at the same time, so it's really important to understand the decision-making process than it is the actual decision. Does the team have that process to make the decision when the time has come based on some evaluation criteria and operating variables that they may or may not control?
Oddly enough, I know a guy, I can't consider him a friend. He was an acquaintance probably 15, 20 years ago when his wife was in the delivery room or at least getting ready to go into labor. He went out and bought himself a Corvette because he felt that he would never be able to buy one again. So I don't think he won any Husband of the Year awards or necessarily Dad of the Year awards, but I guess he checked that off his bucket list. Whether that was a good decision or not, I think that one falls into one of the poor decisions. But let's talk about those decisions when it comes to scale. And I sit back and I look at your organization, and I've invested in your organization. We've done business together, and I look at the growth and the trajectory you're on. And I sit back and sometimes I wonder, I say, are they scaling for growth? Are they hiring this many people and moving into an office and getting ready for what's coming? Or is everybody pushed to the max and they're all working, 45 hours, and collectively, when you add up all the employees, that means 2 more headcount before I lose people because they're burnt out. There's a quandary in many fast growing organizations for the heads and the decision makers to make. And I think sometimes it's an approach that just happens organically. And other times there's folks that are very methodical and say, we're going to be ahead of that because we found what happens is, yes, people do get burnt out and we're going to lose them, or we're going to miss opportunities because we're too busy to underwrite, a deal or a portfolio that we could have taken in-house. Tell me how Spartan approaches scaling and growth with regards to staffing and hitting the gas and the brakes.
So it's the most important thing that you can do for staffing is to get really clear on your values. And it's because you'll attract the right people. If you're not attracting the right people to the organization, it doesn't matter what you do because you're going to have a mismatch. So for Spartan, our values are in your face and they spell grit. So if any Spartans are working 45 hours a week, they're probably going to be shown the door here pretty soon because that's not our standard. We kind of feel that a little bit more than that is kind of our standard. And if that's not for you, that's okay. We celebrate those and free them up to do other opportunities. But we make that very clear up front. So we're getting people in the door that are ready to lean in and they have grit. They're ready to grow. They're respectful. They have integrity. They're tenacious and they're transparent. Those are our values. And if you're not that, you're going to last here a month and then out. If you are that, then there's amazing opportunities here inside the organization to kind of go with kind of prepping for the future. There's a book by Nassim Taleb called Antifragile. Yeah, Antifragile. And in the book, he references the concept of anti-fragility. And for the listeners, I'll just move to it. It means something that is anti-fragile actually gets stronger amidst disorder. It doesn't mean that it can't break. It's not like you can't bounce a vase off the wall. So for us, just like you guys, we've been looking at like, hey, we don't know when this thing's coming, but the real estate cycles have been happening for a lot of years. We're not going to escape this. So something is coming. We don't know when, but we want to be anti-fragile. So we want to be hiring when everybody else is laying off. We want to have a team in place that's ready to grab it. Over the last couple of years, we have been very reactive because we've been growing really fast. So we have been reacting and bringing people in. And so far, we have a pretty good retention rate. We've got about, I don't know, maybe a 5 or 6% turnover. We've only had one person quit. We've had some people that didn't fit, which is going to happen in any hiring process. However, we are building the team that we need for tomorrow, not today. So we actually don't see that as hiring. We see that as investing activities as part of our our CFO function to get that team in place so that when that large portfolio comes in or acquisitions is out there smashing it, bringing in a deal a week, we're not like, how are we going to do this? We don't have the people. They're there. I'd rather take a little idle capacity today to think of that metaphorical spring that you're tightening down and tightening down and tightening down and creating that potential energy by collapsing that spring such that when the time is right, you can pull the cap off and then you get that full potential of the spring versus the limitedness of not being able to take advantage of an opportunity out there in the marketplace because you don't have the infrastructure to do it.
So as people are maybe sitting back and thinking, okay, I can break my core values, but how do I know when to grow and prepare? And all of a sudden there's this anxiety in the pit of several owners and CEOs' guts right now of saying, well, I'm a little anxious because I know that these folks are being pulled and I don't want to spend the capital in bringing in some folks at a salary that may be a little bit higher than what our cash flow permits right now, or maybe they're just fearful anyways that they're not going to be able to recoup that and get an ROI. So I wanted to take a dive, and I know, Scott, that you are all about the numbers, more so than most, and looking at KPIs and certain parameters, if you will, when it comes to hiring or making decisions. We could talk about KPIs all day long, and I think that may turn a few folks off, but I wanted to talk a little bit about some of the KPIs that maybe you're looking at a little bit differently these days when it comes to making those decisions, whether it be on hiring, growth in general, or how you're moving and shifting people around from property management, to asset management, to the various functions. Speak to some of the key KPIs that maybe you're in charge of or that you're looking at, in the Monday morning meetings, over and over again. What are you hammering home right now and looking at very closely?
The one thing I pay attention to the most is cash. Cash is the lifeblood of any business. Most problems outside of like really nefarious shit or criminal activity or something like that can be solved with cash and time. And generally, cash buys you time. It is your most valuable resource. And you can get that generally by leveraging cash, right? If your loan doesn't close right away, okay, well, if you got 50 million bucks just hanging around, you can probably buy that extra month. If you don't buy any deals and your transaction revenue is low, you got big staff, you got a bunch of cash in the bank, you can buy time. So that's really the one thing I look at is cash on hand and our current burn rate. And that current burn rate is based on our monthly recurring revenue. Inside of Spartan, we have multiple lines of revenue. It's one of the key reasons why we established our own property management company. Is a lot of revenue for that comes into the business and it funds other parts of the business. Same with our construction company. Revenue from the construction company comes in for that as well. That also funds the business. So we look at MRR, the monthly recurring revenue, as a percentage of our fixed overhead costs to include office space and salaries, less bonus and commissions, because bonus and commissions don't have to be paid. Salaries have to be paid, right? So when we look at that, our goal is a 12-month run rate, which means we can sit idle and stare at the wall for 12 months with our current MMR without buying anything and still be okay. We're burning reserves, so we're not in a fantastic position, but that's our goal, is 12 months. Because we figured out 12 months, we can probably solve most problems given the time. Keep reserves at all the facilities and nothing crazy. I think the only thing that we do that maybe other firms don't is we have an inordinate amount of cash sitting around like for a rainy day fund because we know it's coming. We also have that cash because we know we're a newer group. We started in storage in 2017. That's only 5 years. There's groups out there have been doing this for 30 years, right? Mm-hmm. Knew that we're going to make mistakes. period. You can't grow that fast in something that's new and not make mistakes. It's silly. So having cash on hand, again, buys us time. So if we have a cash shortfall, we can fund it. We don't have to tap our investors. If we misjudged on how much something was going to cost, can take care of that. So having that cash on hand is really important, and understanding when you run out of it. So as a CEO, when you're looking at that, look at your monthly recurring revenue, stuff that's coming in without you having to buy stuff, because that's what the market will change. It will, or sell, buy or sell stuff. So no liquidity events, whether it's an acquisition or a disposition. How many months on hand do you have in cash to keep the lights on and all of your staff in place? And if it's a month, okay, that's a bit dicey. I can't really fix stuff in 30 days. 90 days? Some of the experts might argue 90 days. 6 months, most people are like, yeah, that's actually really good. 12 months, a lot of our advisors on the finance side are like, hey, you guys are sitting on too much cash. You're losing opportunities. That's okay. Like for us, our vision is for our team to grow personally and professionally. We have a mantra, protect the team, which is why we miss out on investing activities with operating reserves for Spartan, because we're keeping those there just in case something happens.
Mm-hmm. Yeah, our financial advisors basically advised the same. We ran for 6 months for many, many years and felt comfortable with that. It gives us still the opportunity that if we do need to tap into that cash for some short-term transactional funds and then pay it back when a loan closes, they give us a comfort level as long as we are disciplined enough and diligent enough to be able to pay that back. And when I say we, I mean speaking for anyone. As we are now heading into this next economic cycle, we took some cash off the table, some profits off the table. We sold a lot of properties last year and this year, and we're now staying at 12 months. And that makes me feel a lot more comfortable. Spartan is a larger organization in terms of the team and its expenses. That 12 months, I wouldn't bat an eye at an organization your size. Certainly ours, as we've been scaling up the investment side of the business, 12 months feels really good, because I also have it is still a recent pain, and I didn't experience it myself, but watching so many good companies and friends and business associates back in 2008, 9, and 10, they burned through everything. They didn't have enough reserves, and they held on, and they probably still paid too long, and they went into their, the CEOs then went into their IRAs and remortgaged their houses and sold everything else off. And I don't ever want to be in that position myself. And I also, we're a model for those that we work with, and the folks that are in our mastermind, and those that we teach about the business, and quite honestly, our vendors and everybody else for that matter. And so, no, this ship is not going to go down because I failed to budget enough. And we can wind things down pretty quickly. We know how to do that, what that looks like. And we've got a little tougher skin now. If we have to scale back in terms of our staff and our team, we don't want to, as you mentioned, because that's difficult to go find those rock stars, and you've spent all this time finding them, grooming them, making sure that not only they are in alignment with your core values, but now it's embodied in them. That the last thing you want to do is knock on their door and say, hey, I'm sorry, but we don't want to ever be in that position. So for us, a 12-month burn rate right now gives us lots of room to be able to even hang on to those folks when it may not make sense, but we know that things are going to turn back around and things are going to go. And again, as I say, turn around, as we head into the recession, as you mentioned, we see nothing but scaling up. We are just preparing for the worst case scenario if something unforeseen happens, that we can't grow like we think we're going to continue to grow through this recession, that at least we have those reserves there in place.
Yeah, I think it was Jamie Dimon, the CEO for JP Morgan, said that in his opinion, there's a 20 to 30% chance something happens worse than a deeper depression. Mm-hmm. That's I would imagine he's got a pretty good pulse on things. Mm-hmm. CEO of the largest bank in the world. I think Chase is. We sure have a lot of money with him, but it's really interesting, kind of our global geopolitics that are going on right now. In the history of the world, the past couple of years have been some of the safest times we've ever been in. Some people were like, "Oh, it's completely unsafe." No, it's not. There's not marauders ransacking your village. Genghis isn't walking around just being a menace. Mm-hmm. We're getting close to approaching a pretty unsafe time. Mm-hmm. So I think it's one of those things that having capital availability is one thing, but also having that team flexibility, having the right people on your team that can stomach hard times. Having a bunch of folks that have weak constitutions coming in to try to do real estate investing in a really tough time, I'd be leery about that. Those folks that are hiring now worry more about fit, grit than anything else.
Yeah, clock watchers need not apply in our organization, and we don't come out and say it, but we come pretty close to that. And that is, here's our expectations, here's our core values, and we learned a long time ago to not bend on those at all whatsoever. So let's shift a little bit now to the perspective of moving from teams to long-term versus short-term and having that flexibility. How do you approach the market in terms of, within the fund or the individual assets? We were talking before we got on camera about doing some developments maybe outside of your fund and for different reasons or various reasons, maybe being able to pivot a little bit more, having more flexibility. But are you generally playing the long game right now as we head into, and I know the answer is, well, we're flexible and we have optionality. But if you had it your way, Scott, do you think that you're going to be able to produce returns for yourself and your investors by long-term holds? When I say long-term, not just capital gains, but in that 5-year plus range, or is the model still to really, look to exit within 3, 4, 5 years just to be nimble and have that as an overarching business plan?
I mean, we're trying to still stay with the 3 to 5 years. 3 probably, I don't know about that, but probably on the 5-year time frame. And one of the things that we're really trying to educate investors on is kind of the sensitivity analysis that we produce. Hey, we want you to see the worst, best, and most likely cases that we're projecting out for 5 years. We're also educating investors that we don't want to lose money. So if the time that comes early should sell, pigs get fat, hogs get slaughtered. Mm-hmm. So kind of going back to your comment that you guys have left a little bit on the table, that's actually a good thing. There's a gentleman that I've studied, his name was Bernard Baruch. I always say his last name right. He was a sugar baron around the turn of the century. Mm-hmm. He has a quote that I love. I am rich because I always sold too early. And it's one of those things I really appreciate that. And it's one of those things that we really tried to cultivate a tribe of investors that are flexible with us such that, we can be that tree that bends in the wind. Of course, we want to hit everything that we say we do with our investors. If our operating environment turns on us, we also want the flexibility to be like, hey, let's not do this today. Let's wait another 12 months or 18 months. It's a really bad environment out there. The properties are cash flowing. They're doing well. Let's wait. Or, hey, when stupidity knocks, answer the damn door. Which is what you've seen happen here recently when new money comes in and they're not as versed, or they have just a different capital stack. Stupidity to us might look like somebody that has a 0.05% bond out there money. So their capital stack is 8% more efficient to us. So they're looking at us being like, oh my God, you're leaving all this on the table, right? So it's really a matter of perspective. When opportunity knocks, open the door and walk through it. And if that's 12 months in, that's 18 months in, getting the money back to some investors is kind of a pain in the butt. But guess what? I know a couple of guys that have some home for it. So don't stress. We'll get it back out there.
I think that there's a whole lot that you can read into that only experience will teach you, and that I've always had the goal as a beginning investor of leaving something on the table. I want to use this thing up and wring every last dollar out of it. And this property, this project is not only stabilized, it's stabilized plus. There's nothing left in it. And now I'll sell it because my money is sitting idle. And then you realize really at the time when you begin bringing private equity in that maybe that is not only a little bit risky, but if you can't continue to produce the same returns if something is stabilized, and then maybe wait for cap rates to come down because, well, what if they don't, or that time that it's sitting there languishing and not creating any more value, then the internal rate of return, the time value of money creeps in. And now all of a sudden your investors may not be so happy with the returns that they get at the end when you decide to exit. So always looking to the washing of the money, the time value, and rinsing and repeating and creating more value for your investors when the market is good and mitigating the downside risk. That is a byproduct now also becomes more to the forefront because they want to make sure that you're protected. And if you get that internal rate of return, there may be the one or two folks out there, the investors that may say, well, now I got to place my money somewhere else and didn't hit the equity multiple. But I said, yeah, but if you put it into something again right away, or even within 3 or 4 months with these same average returns, like with our projects, you're going to be, you're still going to double your return, and you're going to be more than, higher multiple than that equity multiple that we put on that one project. And they appreciate that. But I think the side benefit of that, Scott, is that then I begin thinking like that type of an investor when I'm protecting my investors' money. Whereas before I was maybe a little more risky and a little more, call it greedy, but just wanting to wring every last penny out of a project and recognizing that, the best to me, the best exit right now truly is that win-win. If you leave meat on the bone for the next investor, it's attractive to them. They're going to come back and buy more properties from you. You've made money for your equity partners that have come alongside of you, and you're going to continue to win if you do that, because you don't want the market to dictate when you have to sell versus being in a position when you want to sell.
And there's also good business part of it, right? To allow somebody else to come and eat at the table. There's a lot of good that comes out of that. And then reputation matters. And if you get a reputation for being a good, honest seller that's leaving meat on the bone for the next person to eat at that table, your ability to transact both up front and on the backside, because the brokers will get to know you pretty well. And buyer groups will as well. Make no mistake, like, we know who our sellers are and we know who our buyers are. So if we're able to leave meat on the table, on both sides, and somebody's leaving the meat on the table for us, and we know that they're an honest, reputable seller, our level of scrutiny, we still have our process, but our cynicism, I will say, that comes in with a new seller won't be as high as it is. Hey, these people are good folks. On the flip side, the cynicism that comes to you as a seller from buyer groups out there, there's a lot of folks that are rolling it up just like we are. So you may be selling multiple different properties to the same buyer in different transactions. More honest you are on that side of the house, and the more that you allow them to achieve their goals, I think it's one of those that help people get what they want, and generally you'll get what you want, right? That's that's the go-giver mentality, I believe.
Yep. Mr. Ziegler is the one who is given credit to coining that phrase.
And that's really what it's about too. It's about being good stewards of business on all sides, earning our investors a good, solid return, and being good stewards so that there are other opportunities for investors to continue to make those returns. So it's not just a transactional one and done. It's a transformative relationship that lasts for 10 years and whatever. But just being really good stewards of business out there will help you have that transformative long-term relationship with everybody that you have, such that the business keeps growing. Investors have multiple opportunities to kind of reinvest and continue to make those returns so that eventually the multiple isn't an issue.
You know, it's interesting. Playing the long game, I've always been about the long game, whether it's the jokes I play, the punchline could come maybe years later. And, also studying people in business that wait long periods of time. And I think even a good story about the Russian chess player, and I forget his name, and maybe the famous guy who he waited until that penultimate match against, the world's best, when he did some move, the king to place on the table, and the guy, and beat the guy, the champion. He said, "Why did you do that? You've never done that." He studied his competition, and he said, "You've never done that before." He said, "Well, I was waiting for just the right time to play you. And, so after 25 years, I was able to make that move." And I think that's very important, to keep in mind, is always playing the long game. And that goes with integrity. And it also goes with just an operational kind of mandate that we set out for everybody, is that, hey, we are in this for the long game, and we will always give up short-term gain if that means that we have the opportunity to do business with somebody else again. We may lose money, we'll spend a little bit more money, but we want to have a reputation that is going to supersede this deal, and it's going to supersede this economic cycle and be known that way. And so the times that we have given up some profit or spent more money to protect our reputation, that has come back many, many times, not only immediately with our equity partners who I thought, oh my gosh, they're never going to invest with us again. Here's a mistake that we made. We covered over it with cash. We made good on it. But the fact that we made good on it then put those investors in a place where they're just like, I can go somewhere else and maybe get some higher returns, but at least I know what I've got with these guys. Yep. With Kingdom is that, if they make a mistake, they own up to it and they're going to fix it. And that goes a long ways. And now being on the other side of this, we just closed a very large transaction with a large institutional buyer. And they're coming back on us now and making some claims against us that without any type of information, they're just stating these claims and accusing us of something and wanting money back. And they said, well, can you bring forth those claims and what exactly it is that you're talking about? And I've already got a sour taste in my mouth of thinking, I don't think I want to do business with these guys again, because the second time they pulled some shenanigans at closing and now post-closing before we got to the end of our reconciliation period. And that goes a long ways. And a little surprised, larger player, well-known in the industry, but burn me once, shame on me, or shame on you, burn me twice, then shame on me. And I won't do business with these folks again. And it's always surprising to me out there to find some folks that are not always playing the long game. And so I don't know if I'm making a comment more than anything, Scott, to anybody else out there, that it's, this in terms of the self-storage industry, it's a pretty big industry and it's a really small industry, right, that you can only do that once. And I think that's going to come back to bite you.
And frankly, that's just not the person I want to be. I want to be the person that negotiates a tough deal, but a fair deal.
And people appreciate that. It's just, that is playing the long game. They appreciate that. And if they always know what they get and that you do what you say, at the end of the day, that's what matters the most. Yep. And that comes, again, back to hiring on core values and making sure you ferret out and get the right people on the bus and the wrong people off as quickly as possible. So let's shift gears once again now as you're looking at approaching upcoming economic cycle, and whether the listener agrees that we're in a recession or not, it's forthcoming. 2 quarters of negative GDP or all the other factors, the bond yield curve, whatever we're looking at, we're heading towards it. What are some of the key pieces that you're either looking at in terms of your strategy and how you approach the market, going back to our first question, but maybe some of the actions that you're putting in place right now that you're willing to share?
So I think one of the key things is discipline. Because discipline trumps recession. A friend of ours said that, and I really appreciate his words in that regards. And we're really kind of doubling down on bolstering our processes and our procedures, training new team members to make sure that those processes and procedures are followed even amidst the growth. So that's the number one thing that we're doing right there, is to get really disciplined on the things that work and go back to it. I've studied Napoleon, and one of the kind of things that really happened with him in his later campaigns, culminating at Waterloo, one of his historic defeats, was he started to deviate from the things that had worked for him. And it's due to a number of different things. But for us, we're really trying to eliminate any deviations away from the things that have worked in the past. Mm-hmm. Not that the past always predicts future performance, but there are certain fundamentals that just will always be there. It doesn't matter what the operating environment is. Your standards are your standards. Don't deviate from them. Mm-hmm. The other thing that we are looking at is we're just trying to underwrite a lot more flexibility in the side of the house, mm-hmm. right? Which everybody should be doing. Just know that if you think it's going to take 90 days, you better have in your contract to be able to buy some additional time for that lender that may or may not be as motivated as you are to close. Mm-hmm. Have some cash reserves and have a way to fill them back up so that when you come to the closing table 48 hours out and the lender's it's $2 million more. We said we'd give you 10 million, but okay, well, that's not fantastic. But mm-hmm. you can sit there and you can stomp around it. You can play your little violin. You can cry and bitch, but the lender's going to be like, and okay, oh, well, just know that it's coming and be prepared for it. So that's kind of one of the things. We're keeping a little bit more cash on hand, keeping some flexibility in our investor network to kind of fund shortfalls kind of at the last minute. We've got some of our key investors that we have really deep relationships with. It's hey, man, I might call you on Wednesday and I'm going to need you to go to the bank and wire me a couple $1 million, right? To generate those deep relationships mm-hmm. and we have that ability to be flexible. So I think those are the 2 main things. Otherwise, just stick to your guns and just don't try to anticipate the market. You're not going to be very good at it. So stick to your guns, build some flexibility in here or there that we know will happen. Banks are going to change your terms. They're going to change your interest rates. You're going to lower your proceeds. Your LTVs are going to be lower. If you're underwriting, you should underwrite 60% LTV and then get surprised when you get 65. Don't underwrite 65 and get surprised when you're 60. Very, very, very hard to mess with that.
And for the listeners out there that are listening to a couple of folks that have been around a while, the veterans know what we're talking about. Some of the less seasoned investors maybe getting a little scared right now and decide to sit on the sidelines and wait till things calm down and normalize a little bit. And I will tell you, don't. There is almost always a life preserver or a resource or having that optionality, a place or a guy you can call as you get down the path on your first deal, your next deal, until the final door closes. This is the time to get off the bench and make sure that you're getting in the game. This absolutely, making sure that you know what you're doing, building yourself a team of contacts of folks that you can go through for your lending sources, your private equity, property management, getting the major pieces figured out. It doesn't have to be building a large organization, but making sure that you have those resources available and then begin to go down that path.
Yep.
But also, I don't really have anything else to add to what you just said, Scott, which is, right now we've seen during the pandemic and really the past 2 years, we've done a lot of pivoting. Some things happen really quickly, some big shifts in different directions and pendulums swinging back and forth where we just like, well, let's tear up that plan and start over again and go back to the original or a completely different one. And you navigate through that by way of just having resources, but also now coming in with that expectation. I think that's what we've learned is that and through doing the exact same things that you mentioned and going through underwriting, no longer are we underwriting with a 3% increase in rates year over year for the next 5 years in our spreadsheets and a 2 to 2.5% on expenses. Now we're going to a more dynamic underwriting model where we're looking at things for what we think is going to happen in this quarter of this year going forward, and what's going to happen now. Where we're going to have a lease up, we know that we're going to affect some change in this facility right away, and so we're going to underwrite it that way. Yes, all valuations and numbers are based on net operating income and a cap rate for a year in terms of valuations in 12 months. But we're dialing those in by month and by quarter to make sure that we have a very accurate picture and know how to predict exactly what's going to happen, we feel is going to happen, so that we can prepare for that a little closer. But going back to the basics again, and just making sure that you're smart about the way you're approaching it, having that optionality, but expecting to be able to pivot and really anticipating that and looking at things with a finer tooth comb and for what's happening in real time right now and what's going to happen next quarter versus next year or 2 years down the road. So I appreciate that, and I think absolutely that is the way to approach this market is to be prepared for things to turn on a dime, but then also have your plan B in place when it does.
I agree.
Well, Scott, I appreciate once again always being able to turn on the camera and the microphone so people can really kind of look into our back and forth as to our check-ins with each other as to what's going on in the market, what you're doing, and to be able to share that and always appreciate your wisdom and to be able to to point to what Spartan's doing. You guys are just knocking it out of the park, and just appreciate you and everything that you're doing for your investors and for us.
Really appreciate the opportunity to be on the podcast and to be part of the mastermind. It's been a transformative experience for me, and I very much enjoy it and looking forward to November at the Hunt Club.
Yeah, I am as well. It's going to be, another epic event, and looking forward to it. And for anybody out there that's interested in looking at what it's like to take it to the next level and be in a room with the A players, and come check out our mastermind, we would love to have you come alongside of it. It's an incredible group doing some incredible things. So you are an avid reader. You mentioned 3 or 4 books. What's on your table right now, or that you're reading that you're really liking, that you're diving into, or is there something that you would recommend to folks, a book top of mind that you would recommend for folks to be diving into as well right now?
I think there's 2. One for just kind of general education. There's a book called Leaders. It's about Lincoln, T. Roosevelt, F. Roosevelt, and Lyndon Johnson. Really, really, really good book. Just on those 4 leaders and leading through crisis and kind of the teams that they built. So it's really an apropos book for right now. Mm-hmm. And the second one for managing your business, 4 Disciplines of Execution, 4DX short. Both like fantastic books.
And how many times have you read 4DX?
Twice. Yeah. So
I think I've been through it twice, and then I refer back to several chapters. And also I need a kick in the butt anytime I'm getting ready to, if I feel like I'm lacking execution or my team is, and I need to go back and grab some verbiage to get the team fired up again. Yep. But always good, always good. Leaders I don't have, so I appreciate that one as well. And right now is the time. I've been just doubling down on leadership, period. It's just anything I can get my hands on. Most of my podcasts right now, anything I'm listening to is based on that, as we're heading into a time in which, I think we all need to step it up. So appreciate that as well.
Yep.
All right. With that, Scott, appreciate your time. Looking forward to seeing you again at the next mastermind, and we will catch you on the flip side.
Well, thank you, sir. Appreciate it.
Hey, gang, wait 3 things before you leave. First, don't forget to subscribe to the Self Storage Podcast and turn on your notifications so you never miss another episode. And while you're there, please leave us a 5-star review if you like the show. Second, be sure to share your favorite episodes and more via Instagram, and don't forget to tag us. And lastly, head to the links in the show description and hit the follow and subscribe button on Twitter and Facebook to get a front row seat as we grow and scale our business and bring you along with us. Take care.